Look at the screen in front of you. Look at the numbers scrolling by, the green arrows, the steady hum of the trading floor. For years, we have been conditioned to believe that this machine is unbreakable. We have been told that the market always recovers, that dips are buying opportunities, and that the sophisticated algorithms of Wall Street have priced in every possible risk. But there's a flaw in this logic. There is a variable that the models cannot account for, a force so destructive and so unpredictable that it shatters every economic rulebook we have ever written. You are about to witness the collapse of the greatest financial bubble in human history, and the trigger has already been pulled. It is not a housing crisis. It is not a dot-com bust. It is the return of global conflict, and it is about to unleash chaos on a scale that the modern world has forgotten. The unthinkable is about to happen to stocks, and by the time you realize it, there will be no exit. To understand why the apocalypse is looming over the stock market, we have to strip away the noise and look at the fundamental reality of war. In the 1990s and the 2000s, we grew up in a world where the end of history had supposedly arrived. The Cold War was over, trade was global, and borders were opening. This era of globalization allowed corporations to chase cheap labor around the world, keeping inflation low and profits high. The stock market became a reflection of this efficiency. But that era is over. We are entering a new era, an era of fragmentation, an era of walls and weapons. And here is the terrifying truth. The global economy was not built for a world war. It was built for a world at peace. When you introduce the friction of armed conflict into a system that relies on the friction-free movement of goods, capital, and energy, the system snaps. We're seeing the beginnings of this right now. We see in the Red Sea, where shipping lanes are choked. We see in the drone strikes on refineries. We see it in the frozen assets of central banks. But the market, in its infinite arrogance, is looking at these events and seeing them as temporary blips. They're not blips. They're the tectonic plates of the global economy shifting. Let's talk about the specific mechanism of this crash, because it won't happen all at once. It will be a slow bleed that turns into a panic. The trigger is the intersection of two deadly forces: war spending and energy prices. History teaches us that war is inflationary. It always has been. Think back to the 1940s. Think back to the 1970s. When a nation mobilizes for war, it spends money it does not have to destroy things it cannot use. It creates massive demand for raw materials, steel, copper, aluminum, and most importantly, oil, without producing any consumer goods in return. This is a recipe for skyrocketing prices. Right now, the United States is funding wars on multiple fronts, while simultaneously trying to deter superpower in the Pacific. The cost of this military machine is astronomical. But here is where the unthinkable part comes in. In the past, the U.S. could afford these wars because it was the world's banker. Today, the U.S. is the world's largest debtor. We are funding a global military campaign by borrowing money from the very nations we are potentially preparing to fight against. This dynamic creates a pressure cooker in the bond market. The bond market is the foundation of the stock market. When bond yields rise, stock valuations must fall. It is simple math. If you can get a risk-free return of 5 or 6% on government bonds, the risky gamble of stocks becomes much less appealing. War spending forces the government to issue massive amounts of new debt. To get people to buy that debt, the government has to offer higher interest rates. But as rates rise, the interest payments on the existing national debt become so large that they crowd out everything else: education, infrastructure, and yes, the corporate subsidies that prop up the stock market. We are approaching a fiscal dominance trap. The government needs to borrow so much to fight the war that the Federal Reserve is forced to step in and buy the debt, effectively printing money to fund the war machine. This is what causes hyperinflation. If the Fed prints money, the dollar crashes and stocks crash in real terms. If the Fed doesn't print money and lets rates soar, the economy collapses under the weight of the debt and stocks crash in nominal terms. This is the trap. This is the checkmate. There is no way out. And then there is the oil card. This is the wild card that terrifies even the most seasoned analysts. We are watching a slow-motion energy crisis unfold. The global supply of oil is barely keeping up with demand. A major conflict in the Middle East, or a blockade in the Strait of Hormuz, would cut off a significant portion of the world's energy supply overnight. Imagine a world where oil prices double or triple. Such a shock wouldn't just hurt you at the gas pump. It would destroy the logistics chain that delivers food to your grocery store and parts of the factories. It would act as a massive tax on every consumer and every business. Corporate earnings, which are already inflated by cost-cutting, would evaporate. The stock market is currently pricing imperfection. It is pricing in soft landings and resolved conflicts. It is not pricing in $200 oil. It is not pricing in a global naval war. When the realization hits that the energy supply is no longer secure, the panic will be instantaneous. So, what does the unthinkable look like when it finally arrives? It looks like a day where the market opens down 10% and the circuit breakers kick in. It looks like a frozen credit market where companies cannot borrow to pay their payroll. It looks like a rush to the exits that turns into a stampede. It looks like the realization that the debt is unsustainable and the currency is devaluing. It is the moment the leverage breaks. We have built a financial system on a mountain of debt, corporate debt, government debt, margin debt. War is the shock that causes the mountain to crumble. When the dust settles, the world will look very different. The dollar will be weaker. Gold will be much higher. The stock market, as we know it, will be a shadow of its former self. But the most terrifying part is that this is not just a prediction. It is a mathematical certainty. You cannot run a global empire on a printing press while fighting multiple wars and expect the currency to hold its value. You cannot expect stocks to thrive when the supply chains that feed them are severed by conflict. The disconnect between reality and the stock market has never been wider. The war is the catalyst that forces reality to reassert itself. The market is a voting machine in the short run, but a weighing machine in the long run. The war is about to reveal the true weight of the American economy, stripped of its global hegemony. And that weight is far less than the current price suggests. As you watch the news and see the maps of conflict spreading, do not look at them as distant events. Look at them as dominoes falling directly towards your portfolio. Every missile fired is a tax dollar burned. Every ship sunk is a supply chain broken. Every sanction imposed is a market lost. The system is fragile, more fragile than anyone wants to admit. The architects of this system built it for a world of cooperation, not confrontation. Now that confrontation has returned, the system is breaking. The unthinkable is not just a stock market crash. It is the end of the financial order that we have lived in our entire lives. It is the transition from a unipolar world of American dominance to a chaotic, multipolar world of scarcity and conflict. The smart money isn't trying to predict the exact top. They are already moving to the exits. They are preserving capital. They are buying real assets. Because when the music